Good morning. In this video, I'm starting a weekly discussion related to accounting. In this chapter, we're going to be discussing the role of accounting in business. Consider this class an introductory class into accounting and the importance of accounting related to the operation and management of a business. Accountants are concerned with the management and recording of business activities. These business activities are divided into three specific areas, including financing activities, operating activities, and investing activities. When we think about financing activities, we're thinking about how a business starts up in terms of the contributed capital of owners and investors, as well as financing, either short-term or long-term. When we talk about operating activities, we're talking about the day-to-day operations of a business, such as recording revenue, recording expenses. And then when we focus on the investing activities, we're talking about the long-term transactions that have a benefit to the organization, such as purchasing assets, purchasing equipment, purchasing buildings, identifying long-term contracts that actually sustain the operation beyond the current period. Let's spend a few minutes and talk about the details related to each of these activities. When we talk about financing activities, we're talking about two primary forms. What's identified here is liabilities, as well as what we call contributed capital or common stock. As we go through our discussion, we'll actually make a distinction between what we owe in terms of liability and ownership that is embedded in the equity section of the balance sheet. When we think about liabilities, there are what we call short-term liabilities. These short-term liabilities are the elements that need to be paid within the next period. Generally speaking, these are items that need to be paid within the next month. As an example, accounts payable is a liability when a company borrows from a vendor or supplier. If you are a business owner and you buy supplies from a vendor and you buy supplies on credit, the amount that you owe is an accounts payable. A bond payable is a long-term debt. Generally speaking, a larger business may establish a bond, and this bond is going to be issued very similar to stock, but generally speaking, what will take place is that the bond is a long-term obligation, meaning that you're going to be paying interest on this bond, but also paying back the principal maybe 5, 10, 15, or 20 years later. The next category of liabilities that we talk about is our notes payable. A note payable is where we borrow money and we agree to pay back the principal plus interest. The notes payable may be either a short-term or a long-term. Again, it's considered short-term if we have to pay it within the next period or within the next year. It is considered long-term if the payment structure is beyond the next year. The final category that we want to talk about is not a liability, but represents ownership. Shares of ownership issued in the form of common stock represents the opportunity for an investor to own a certain portion of a business. We talk about this as being common stock. Another term that we might want to use is contributed capital. The next category of activities that we want to talk about are investing activities. Investing activities represents activities that end up where we have assets that are owned by the company. Assets represent resources. These assets may be either tangible or intangible. Tangible assets have physical characteristics. An automobile, a building, equipment. These are tangible assets. During this course, we'll also talk about certain intangible assets. These intangible assets do not have physical form, but what they represent is ownership, generally speaking, contractual ownership Included in intangible assets are things such as patents, copyrights, and goodwill. Prepaid expense is another example of an asset. A prepaid expense represents something that we pay for in advance that creates value. An example of a prepaid expense is insurance. So consider us buying a fire insurance policy that is good for 2 years. When we buy this policy, we have an asset. The consumption of this asset, where it becomes an expense, occurs over time. So what we're going to be talking about in this course is how we actually allocate this asset as a prepaid expense over time such that we are expensing the amount in the specific period. An accounts receivable is another asset. An accounts receivable occurs when we sell goods on credit or on account. You'll notice that accounts receivable essentially is the mirror of what an accounts payable is. So when we buy something from a vendor on credit, we, as the purchaser, has the payable. The vendor that's actually selling it has a receivable. Let's now talk about our final but most important activity, which is the operating activity. The operating activity is what a business does to sustain itself as a going concern. What we're specifically talking about is the generation and recording of revenue, as well as the accounting for expenses. Sources of revenue include sales, as well as fees earned. Expenses include 3 categories, primarily our cost of goods sold, selling expenses, and administrative expenses. As we talk about the activities within an organization, we're looking at 2 specific categories of profitability. The first category is gross profit. Gross profit represents our sales minus our cost of goods sold. Cost of goods sold represents the cost associated with merchandise that we have purchased from a manufacturer and are now selling this to the end user. Gross profit becomes an important metric as we are measuring the success of the organization. We then take our gross profit and then subtract our selling expenses and administrative expenses. From here, what we have is our net income. One of the distinctions that I want to make sure that we understand is that when a business is interested in answering the question, how much are we making? What they're really looking for is what are we ending up with in terms of net income after we've paid our expenses. The accountant is critical in terms of understanding and tracking and measuring the revenue and expenses so that we can answer this critical question, how much are we making? So now that we understand the activities that accountants are involved in, let's bring it together and talk about the information that's provided by accountants. Information systems that provide reports to stakeholders about economic activities and conditions of a business. This is summarized in 2 separate statements. One relates to financial performance or financial activity. This is our income statement where we are measuring the activity during a period. In addition to understanding the activity that occurs during a period, we're also concerned with our financial position. So as we're going through our material, make sure that we understand we are measuring accounting from 2 separate positions. The activity that occurs during the period, where we are measuring revenue and expenses during the period, and our financial position is where we are at a specific point in time related to our assets, liability, and equity. There are 2 separate branches of accounting that become a part of the course that we're focusing on. The first is financial accounting. Financial accounting is where we are preparing financial reports, and we'll be talking about these, including the balance sheet, the income statement, and statement of cash flow. These financial reports are primarily prepared for external users. We will define what external users are during this course. Managerial accounting is where we are using accounting information to make management decisions. These management decisions relate to investing, financing, and operations, where we're not structured by anything other than using information that helps us make good financial decisions. The objective of financial accounting is to prepare financial reports that measure the financial position and financial condition of a business at a specific point in time. This we are referring to as the balance sheet, where we are measuring specific balances of accounts, such as cash, assets, liabilities. In addition, we are preparing financial statements that measure activity during a period of time. This is our income statement. In our income statement, we are measuring what is actually taking place during a period, whether it's a month or a year, and we're determining within that period what was our revenue and what was our expenses. This slide gives us a good understanding of the relationship between the balance sheet and the income statement. Visualize that we are preparing balance sheets at the end of each year. On January 1st, 2016, we had prepared a balance sheet as of December 31st, 2015. This gives us a snapshot of what our financial position was at that specific date. During the year of 2016, we have financial activities, operating activities in terms of revenue and expenses, investing, and financing activities. These are reported in our income statement. Based upon these changes, we then have a new snapshot of our financial position as of December 31st, 2016. I hope this presentation helps you understand the role of accounting in business activities. I look forward to our next discussion.